Another way of thinking about portfolio of assets is basically you just bought a bunch of lottery tickets and you don't know which of those is going to pay off. And unlike real lottery tickets, these things all have a positive expected value, because obviously you shouldn't really buy a bunch of lottery tickets. I mean, buy a few to have fun, but don't put all of your money in them. This is the only piece of investment advice I'm going to give, because I'm not regulated to give investment advice, but I think it's pretty sane to not invest in lottery tickets.
Welcome to the Market Call Show, where we discuss what's happening in the markets and the impact on your investments. Tune in every Thursday on Apple Podcast, Google Play, Spotify, or wherever you listen to podcasts.
Welcome to the Market Call Show. This is Llanes. I am the founder of WealthNet Investments. Today we have an interesting topic and I'm really excited about diving in, so let's get going. Welcome to the Market Call Podcast. This is Llanes again. We have Rob Carver on again for the second part of his interview. We split the interview up in two so that we could give you bite-sized chunks of our conversation. This conversation is very special because Rob breaks things down about how people can make better portfolios for themselves as an individual investor. Individual investors have many challenges that regard to how to do well, especially during times of inflation and when the markets are rough. And Rob brings some really great advice on how to build better portfolios. So listen in. I want to get a little bit into portfolio construction and diversification if we can. So maybe on a high level, like for individual investors, most people are in like a 60-40 type portfolio. We always talk about that, 60-40, 60% stock, 40% bond. But with inflation lately rising, and we've all heard the story, bond prices have been falling, equities could fall too because valuations are stretched. So that kind of changes the correlations between stocks and bonds, going back to that positive relationship, which we normally see long term. And people are not really prepared for that, I think, although they're starting to see it happening now in front of their eyes. But who knows how long that could last or what that's going to look like. I'm not trying to make a prediction, but I think about individual investors, and we see individual investor portfolios, and it's almost invariably, like literally the correlation between all the portfolios we see is like 0.8 or up, because everybody's doing the same thing. They're almost market cap weighted. They have a certain amount in U.S. and international stocks as a U.S. investor, a little bit of bonds. They tend to be hugging the indexes more and more because they own lots of securities, and the performance is very homogeneous, if you will. But we know if we add futures, long and short, and a lot of people are constrained. I think that's one of the biggest problems I think individual investors have, is that they're constrained on the retirement accounts where they really can't go short. Most brokerage firms will not allow you to put futures in there, although some do. But most investors will not do that. And the complexities that we talked about have limited people to doing that. They don't understand futures. And when the market's going up, sometimes they're going flat or down and they just don't, So I guess my question for you is, what do you think the best way is for individual investors now to overcome this potential problem of not being able to make a reasonable absolute rate of return, given the constraints they're having in their retirement accounts, being long only and all that?
If I could really answer this question, I'd probably be very rich, because to me, this is like the kind of big problem that all investors have at the moment. I don't think anyone has a really good solution for it, to be honest with you. So, just thinking in abstract theoretical terms for a minute, while my brain struggles to come up with a more helpful and practical answer. But I guess you can either try and let's assume you can't go outside stocks and bonds. Okay. You want to have maximum diversification within that asset class, or within those two asset classes. There isn't probably a lot to be gained from, let's actually just start at the highest level and say, okay, let's assume you can just trade stocks and bonds. What can you do? Okay, well, one thing you can do is, if both of them go down, then we're screwed anyway, right? But if we think we can predict the relative performance of stocks and bonds, and things like momentum models do seem to do this reasonably well, or have done in the past, then there is probably some additional improvement you can make to your portfolios by, for example, varying between, say, 90-10 and, 80-20 in the other direction, 20-80. So varying on stock and bond allocation. I would never go to 0-100, 100-0, because to do that, you effectively are assuming that your forecast of relative returns is perfect, and it won't be. Mm-hmm. Absolutely won't be. But if your forecast is good, then you will potentially pick up, you won't necessarily make money, of course, because if they're both going down, but if you can stay out of the one that's going down the most, then obviously that's going to improve things by tilting away from, say, stocks, if bonds are going to do relatively less badly, for example. So that's one thing you can do. Now, obviously, there's this idea out there where you potentially also rotate into a third asset, which is cash. I have looked at this, and empirically, that doesn't do as well as just switching between stocks and bonds. And the other thing is, given we're in an inflationary environment, I don't think cash is a kind of panacea really as an asset. So it's going to have negative real returns guaranteed. I personally wouldn't introduce the extra complexity of that. I would just be pulling the handle between stocks and bonds. The next thing we can do is say, well, can we improve what we're doing within stocks and bonds? You mentioned some classic phrases, they're like people hugging indexes. And obviously the other thing that you kind of implicitly mentioned was home bias, right? All investors have home bias, and I'm not immune from this. I'm pretty damn sure that my allocation to UK stocks is higher than yours, Lewis. I know for a fact your allocation to US stocks is also higher than mine. And yet we are both intelligent, rational people who've read the same books. So, what's going on there, right?
I think a lot of people think about the currency, really.
Well, exactly. Yeah. So, exactly. So currency risk is one thing. And my take on currency risk is actually, I like currency risk because it actually makes portfolios of international stocks more uncorrelated and therefore more diversified. And therefore, in theory, at least, it is good. Now, of course, part of the problem as a US investor is that historically US stocks have done much better than anything else. So any kind of back test that looks at historic returns is going to overweight the US. That's, if you like, the kind of quant home bias effect, if you will. Obviously, being relatively out of US stocks over the last few years has been really bad for me until quite recently. And now it's looking relatively better. UK stocks again have done relatively better. So, but without a crystal ball, the thing to say is, well, implicitly what you're saying is, well, I think that US stocks are going to outperform UK stocks. Implicitly, what I'm saying is, I think UK stocks are going to outperform US stocks. Well, unless we have evidence for that or some kind of model that will predict that, then we're both wrong, and we should both be going towards a more neutral allocation. And that neutral allocation is not market cap, because MSCI World is whatever, I lose track, but 40, 50% US, something ridiculous like that. At least it was until recently. Whereas if you were to allocate by some other metric, like say, okay, let's pick all the stocks in the world with at least $1 billion of market cap and allocate equally between those 1/n, the US would probably still have a reasonable share, like probably, 15%, maybe 20% off the top of my head, but there's no way it'd be 40, 50%. And if you think that you can't predict the returns of any of those companies and you assume a homogeneous correlation structure, then that theoretically is the optimal portfolio to have. So the next thing you can do is try and diversify your portfolio away from home bias, make it less kind of market cap hugging. And the great thing is that we can do that quite easily with ETFs. ETFs for most countries, as a US investor, you can buy an ETF for, Taiwan for like 15 basis points or something like that. So it's a great position to be in. And weirdly, in fact, where I used to work, we actually started buying ETFs because there were country equity indices whose futures we didn't have futures for, or the futures were very liquid, but the ETFs were fine. So we used to buy the ETFs instead. So it's not necessarily the case that you'd go futures first in that case. That's the second thing you could do. The third thing you can do, which is probably harder, is to think of an asset class that you can add to your bond and equities that will go up. And this is where it gets really difficult, right? So obviously, I'd advocate, if you can, invest in a fund, or this in Europe. So for example, that it's very hard to find ETFs that invest in say managed futures type strategies. If you can do that, great. It's not such a good idea to do the kind of second best to that, which is to buy a long only commodity ETF, because you've got the so-called roll down effect. That means even if the price of oil goes up, you can actually lose money on an oil ETF, because these things are constantly battling against the shape of the futures curve effectively. But it's a tough one. The only thing I'd say is, and we certainly don't have a time for a full debate on the reasons why, is if you think crypto is an inflation hedge, then I think you need your head examining personally. But
I agree with that.
I'm not here to talk about crypto, and I'm sure there are other people who can.
we won't go into crypto, I promise.
Yeah.
Well, that's really good advice. Just thinking more diversification. So really implementing something like that is more feasible using ETFs, not individual securities, which gives you more diversification. With that said, I don't know how much you have researched individual stock versus ETFs? That was going to be some of my line of questioning. If you have this gigantic correlation matrix of all the individual securities, you can find more diversification there than the ETFs. I mean, like if you do the same thing in the ETFs, there's definitely less diversification there. So what is your thought about trading? Like, what is that delineating line where you would say, I'm not going to trade individual stocks, but I'm going to go with ETFs? Would it just be always, it's better to go to ETFs? Or do you think there is a point where individual stocks with, say, a futures overlay or something, or a fund or something like that, would be a better way to go from a portfolio construction standpoint?
Yeah, this is the thing I look at in quite a lot of detail in my second book, Smart Portfolios. The things that are going into that are a couple of things. Firstly, costs. And what I'm really thinking about now is the kind of per trade cost. So if in the UK in particular, we typically pay £8, so that's what, $11, $12 roughly for each trade, and that's cheap.
Wow.
Yeah, exactly. So for a UK investor thinking about the ETFs versus individual stocks decision, it's an easy decision because you know what? To replicate or to do a good enough, let's say that I thought that buying one stock from each of the GIC sectors, so buying 11 stocks in all, would give me an adequately diversified UK portfolio. And so it's equal weighted, so it's not market cap weighted. So it is one from each asset class. That's diversification. That's nice. So I need to buy 10 stocks basically, or alternatively I can buy a FTSE 100 ETF that's market cap weighted. Okay, it has more stocks in it, so it's more diversified. But on balance, I think the equal weighting overcomes the effect of the loss of diversification. It might be that I also have some way of picking those 10 stocks through valuation metrics or momentum or something like that. That again means I think I can do a little bit better than just a equal weighted with fixed equal weights, for example. But the problem is I've got to buy 10 stocks, and that's going to cost me £80 in fixed commissions versus £10. Sorry, £100 versus £10 in fixed commissions. So depending on the exact size of my portfolio and how long I may intend to hold those things for, there's sort of a break-even point at which it no longer makes sense to buy the individual stocks. So if you're a UK investor with, say, I don't know, £1,000, or, $1,400, it probably doesn't make a lot of sense for you to buy individual stocks. Your best bet is just to buy, it's MSCI World, bang, done. You've got one thing in your portfolio, but it's everything, right? And you can do Vanguard 60-40, again, just buy, it was one ticket investment, bam. I'm not endorsing Vanguard, it's cheap, and
Sure.
There are other people who provide the same thing, but I know for a fact that's a very cheap fund.
For sure.
But for a US investor who's facing much lower per ticket transaction costs, or maybe even zero, potentially, depending on which broker you use, then that becomes much less of an issue. Because if you take an extreme example, I suppose you can trade with fixed costs of zero. Obviously, you've still got the bid ask, but that's a percentage cost, so it doesn't affect this particular decision. If you've got fixed costs of zero, well, it costs the same to buy an S&P 500 ETF as it does to buy 500 US stocks. Okay, you've potentially got fractional issues with 500 stocks, so that's potentially an issue. So, okay, that sort of feeds into the decision as well. But putting that to one side then, as an individual investor, well, I could buy 500 equal weighted S&P 500, or I could buy S&P 500 market cap weighted. If that's going to cost me the same, then again, if I don't believe that market cap is an indication of future performance, then equal weighted should outperform. Therefore, I could do that thing of buying all the individual stocks. The other thing that comes into the equation is like, how bad is the ETF? Okay, so, and I don't mean the ETF as in, but really how bad is the index? So the S&P and the 500 and the FTSE 100, I mean, they've got sector tilts, and you would say there's too much tech in the S&P, or there's too much mining and resources in the FTSE. But have you ever been to Canada or Australia, or like Russia or anywhere like that, where their headline indices are like all resources pretty much? So I looked at I think it was the Australian stock index, and basically it's banks and miners.
Yeah, that's it.
And the banks are probably correlated to the miners, because guess who they're lending money to, right? So in a scenario like that, you will have a much bigger improvement from investing equally weighting in, say, the top 100 Canadian stocks or Australian index than investing in the ETF, which is basically just buying you effectively two positions, a banking stock and a mining stock. So it's not a straightforward decision. And in the book, I kind of make it as simple as I can. I say, basically, I just bring it down to a table with rows and columns. Rows are, what's your per ticket trading cost? columns are what's the amount of money you have. And then it just comes down to that straightforward decision. So roughly speaking, if you've got a big ticket trading cost and you've got a small amount of money, stick to ETFs.
Yeah. And then you have that little problem of idiosyncratic risk of individual stocks. Where
yeah,
but that's a problem.
Yeah, exactly. Well, that's the thing. But that's why you need to have enough capital to buy enough individual stocks so that you're benefiting from having a better weighting scheme than market cap, but you're not exposed to too much idiosyncratic risk. So like I said, there's an absolute minimum for me personally. One stock in each GIC sector, for example, would be the absolute minimum. So if I couldn't buy 11 US stocks, I would buy the SPY ETF, even though I dislike it. But of course, the good thing is I don't have to buy a SPY. I can buy value-weighted ETF. Again, though, there is then the fact that those normally come with higher fees. So another thing I like to do is say, well, how much extra return can I really generate? And you have to be fairly selective with these things because there are some kind of so-called smart beta. That's what the title of the book, Smart Portfolios, came from, right? There are some so-called smart beta funds which are charging way too much, really. You're not really going to gain any extra from that. So you're better off sticking to just the market cap weighted ETF.
Because they own so many securities, they wind up hugging the index anyway closer, and then you're paying a lot more for it. And over time, the alpha that you're going to get for whatever that supposedly get may not offset that. Well, actually, if I'm looking at the data, they haven't.
Well, exactly. I agree with you. When I've looked at the data, I've seen exactly the same thing.
Yeah. So we do mostly individual stocks, but we have a larger account size. So if you have $1 million, you can have a better weighting scheme, $1 million plus, with individual stocks. But then you have this problem with, I love the concept of using ETFs because it's so simple. So kind of like smaller accounts, we have programs that are ETF oriented for those reasons. But you mentioned market cap weighting as being can be a disadvantage. I say that all the time because I'm a big believer that is a disadvantage just both theoretically, and there's times when it's difficult to beat it because it's got this built-in momentum effect. It's efficient. It's low cost. There's lots of reasons why you can't beat it. It's very difficult. But when you get in markets like we're in right now, that's kind of when you get to the risk adjustment phase, that's when I think that you can kind of add some value. And if you're putting non-diversified long short like futures on top of that, you really can have an edge over the 60-40 that most people are just doing. But not everybody has access to that directly. So the fund makes a lot of sense for a lot of people to seek out funds that are doing these, call it trend following, managed futures. Most of managed futures, I think, tends to be trend following, but there's a lot of other things that are in it now. I wanted to ask about the number of risk units, because that's always an issue when you're dealing with equities, because there's a lot more change going on in the equity world. You mentioned that there's a relatively fixed number of tradable futures contracts. They don't really trade. You don't worry about corn going out of business. So you have this issue of how many number of risk units should I have? What's that minimum number? Because that's a big part of it. What are your thoughts on that with individual stocks? And let's say you want to be globally diversified. What would you say? And I don't know if you've done any research on that or anything like that.
Yeah, I mean, I've not done any formal research on it. I should probably have said up front, I'm not really, although I have kind of been involved in a sort of equity market neutral fund that AHL ran, and I've read the literature. I'm not like a stocks guy, so I mean, take everything I say with a pinch of salt.
That's fine. I was just curious.
Yeah. I mean, so let's say that you think there are 50 countries in the world with stock markets that are worth investing in, and you think that there are 10 sectors, then using my rule of thumb, you should have at least 500 risk units, right? Now, if you put those 500 things in a correlation matrix, you'd probably find there are an awful lot of correlations that were very high, and you could probably get rid of quite a few of those without really affecting the theoretical diversification of your portfolio very much. But this is kind of actually something that's comes out of a lot of the thoughts and discussions I've had about trend following. I think we have to distinguish between the linear and the nonlinear world. So in the linear world, we have correlations. And in the linear correlation world, you get this effect where basically you have the classic kind of curve where as you add stocks to a portfolio, the standard deviation falls, the Sharpe ratio increases, but then it levels off. There's been acres of newsprint wasted with people saying you should have 20/25/50/10 stocks for a diversified portfolio, and this is the kind of the number we're arguing about, right? And that kind of flattening off occurs because correlations are linear, and because amongst the thousands of stocks there are in the world, you do get to the point very quickly where the number of, you're not really adding things that are generally uncorrelated bets, because everything's pretty much correlated to an extent, especially in stocks. But what that doesn't account for is outliers and non-linear effects. So another way of thinking about portfolio of assets is basically you just bought a bunch of lottery tickets and you don't know which of those is going to pay off. And unlike real lottery tickets, these things all have a positive expected value, because obviously you shouldn't really buy a bunch of lottery tickets. I mean, buy a few to have fun, but don't put all of your money in them. This is the only piece of investment advice I'm going to give, because I'm not regulated to give investment advice, but I think it's pretty sane to not invest in lottery tickets. Probably about the same as crypto, I would say, in my opinion. But if you think conceptually about your portfolio of stocks being a bit like a whole bunch of lottery tickets with positive expected value, then what's the optimal number of lottery tickets to hold? Well, actually, it's all of them, because you don't know which of the lottery tickets is going to be the winner. And you could say, well, I've invested in a correlated basket of lottery tickets. But okay, yeah, well, that's fine. But correlation is a linear measure. And because lottery tickets are an asset that basically have something close to a binary payoff and extreme positive skew, to get technical for a second, they're about as non-linear as it gets, okay? Now, stocks aren't exactly like that, but they're certainly not exactly like either the idealized world of linear correlations. So that means I'm always very wary of saying, well, yeah, if you own 500 stocks globally, then basically that's absolutely fine. Because, well, let's say you've sensibly bought 10 stocks in the US, you bought one tech stock. You may have been unlucky and bought the only tech stock in the US that in the last 5 years has done nothing, right? And missed out on the ones that have done really well. Okay, or you might have bought Tesla, and until recently that would have been the perfect stock to buy. That's the issue with specifying this number. And so in theory, buy all the stocks.
That's true.
On the other hand, 500 is probably enough. And this is the same issue I have with futures, because going back to the early discussion we had, if I picked 30 futures, well, theoretically, that's really good, right? It's absolutely perfect. But it might be, or I say, well, you can trade futures. You only need to trade one per asset class. You only need to trade corn, for example. Well, what if this year corn doesn't do anything this year, but wheat goes insane? Even though their correlation is like 0.9, it just so happens that this year corn's done nothing, but wheat's gone completely insane. You're going to feel like an idiot, right? This is the problem with specifying the minimum number. It's a question that really only makes sense in a kind of linear world, and that stocks are not in that world.
If you worry about your investments, need to make complex financial decisions, or pay unnecessary taxes, the lack of proper financial planning and investing may already be costing you a great deal. When you are ready to turn your peace of wealth into peace of mind, go to wealthnetinvest.com and click on the Schedule a Call button to talk to us and get a free consultation today.
I think potentially there's more, that this is where a discretionary trader may have, if you're skilled, can have an edge, because then you can whittle down to maybe a higher probability that one of those is going to be the outlier event, the outliers that you're looking for. But that's always the hard thing when you're dealing with that. That makes total sense. I wanted to talk a little bit about how you blend strategies. We're talking a little bit about portfolio construction. I know in one of your books, I think it's Systematic Trader, you kind of run models for, the return stream. It looks like you're running return streams of the models and then correlating them and then kind of blending them and then you use kind of handcrafting, which I love that word, handcrafting. Can you explain a little bit about how you think about blending your portfolio strategies together?
So, it's exactly the same problem, right? It's a portfolio construction problem. So you have a bunch of assets. So before we were talking about stocks or futures, but now the assets are themselves strategies. But there's no kind of theoretical difference between these two problems. There are some practical differences. So for example, the strategies are run with vol targeting, which means they all have the same expected risk. So I don't need to worry about the covariance matrix. I just need to worry about the correlation matrix, for example. Because these strategies are all amazing and brilliant and wonderful, and I designed them myself, none of them should have a negative weight. They should all have a zero or positive weight, so that simplifies things. And the other thing is that the weights will add up to 100. Because although as a futures trader I can use leverage, in practice what I do is basically everything's targeted to achieve a certain risk. I allocate weights between 0 and 100 to everything. And then there's a third step where I look at the risk of that portfolio and, if necessary, apply more leverage to account for the fact that my return streams are correlated. Not perfectly correlated. But for the purposes of the actual allocation of weights, they just had to add up to 100. So it's a portfolio optimization problem, but one with constraints and simpler in some ways. There's no efficient frontier, for example, because the weights all add up to 100 exactly. So I'm just picking the portfolio that has the best characteristics, and those characteristics will be risk adjusted. So it'll be best Sharpe ratio or best compounded growth geometric return, which actually, if you can use any amount of leverage, is the same as the best Sharpe ratio, basically. I mean, you can look at things like drawdown and stuff like that, but I tend not to, because the risk properties of my strategies are sufficiently nice that I can kind of ignore things like drawdown ratios and stuff like that. So, okay, so I've got a bunch of things that are basically the trading strategies. I do this in two ways. One, I combine different styles of trading together. So I combine different speeds of trend with carry, for example, and other types of mean reversion, so on. And the other thing I do is combine instruments together. So I'll have effectively a strategy that trades S&P, another strategy that trades US 10-year, another one that trades crude oil. And I'm basically, again, allocating capital, and it's effectively a risk weighting to each of those streams of return. So what things do I need to think about when making that decision? Well, I need to think about basically, or standard deviation I have to worry about. I've got to think about correlation, so I'm maximal diversification. And I've got to think about net returns after costs. Returns after costs, well, that's returns pre-cost plus costs or minus costs, depending on whether you put a minus or a plus sign in front of your costs. Now, if you actually look at the statistical significance of these different return streams in terms of pre-cost returns, you can't really distinguish between them. So, for example, the US 10-year trading strategy that I run is better than the S&P 500's trading strategy that I run historically in the backtest, but that improvement is not statistically significant. So there's no strong grounds or evidence that I should strongly favor the 10-year strategy over the S&P 500 strategy. On the other hand, if I look at the costs, then the S&P 500 is a much cheaper thing to trade than the US 10-year. So that has an influence potentially in there. Although in practice, because what I tend to do, as I've already mentioned, is trade things that are more expensive slower and vice versa, the costs kind of end up being about the same anyway. So in simple terms, really the only thing that matters is diversification. That's really the only thing that has any serious impact on what my portfolio weights will be.
So you have different parameters for different instruments then, it sounds like. It's not...
Only for the one purpose of trading expensive things slowly and the vice versa. So I don't, for example, like some people do, say, okay, well, momentum doesn't work well in stocks, therefore we're not going to trade it in stocks, or we're going to trade it with a lower weight. That's true, by the way. Empirically, momentum doesn't work as well in stock index futures as it does in other asset classes. That absolutely is the case. Mm-hmm. But I don't believe that the evidence is strong enough that you should then do that, because you're obviously down the route of overfitting potentially.
So it's really driven by costs.
The
speed.
The speed is driven entirely by the costs, exactly.
Mm-hmm. So you're not making an assumption about a certain type of signal being better than another to some degree.
No, absolutely not. No, because I mean, I'm not like kind of religious about this, but I'm happy to look at empirical evidence. And if I ever see empirical evidence that yes, 100% this type of signal is so much better for this instrument than this other signal, then I would definitely not necessarily completely reallocate, but tilt towards that. But I've never seen that. I've never seen very strong statistical evidence. Obviously, you get different backtested returns, but they're never significantly different. So returning to the allocation decision, the idea behind handcrafting was basically it's essentially a kind of very simple way of doing a top-down portfolio allocation. So what you do effectively is you group your assets. So for futures, I do that by asset class. For stocks, I do it by country or sector. And there are kind of automated ways of doing this. So you can use hierarchical clustering algorithms that will basically say, well, given your correlation matrix, which assets are most correlated with which other assets. And normally that goes along asset class lines, although not always. Sometimes you get some interesting surprises. And sometimes, as I've mentioned earlier, like crypto, it's not obvious. Is it an FX? Is it an equity? Is it more like metal? It turns out it seems to be more correlated with metals than with the other things in there. So it seems to belong in that bucket. So it can be useful for assets that are a bit unusual as well to follow that approach. And obviously, if you're back testing, you definitely want to have something that's automated. So while it's completely fine for me in constructing my live trading strategy to say, well, I'm going to just say, well, clearly these are the asset classes, and then clearly within that, equity indices, well, here's the US equity indices, here's the European ones, here's the Asian ones. Okay, now within those buckets, German, French, UK, and so on. With commodities, you've got grains, wets, and so on and so forth. So there's obvious classifications there. But in a back test, you want to have that automated because you don't want any kind of implicit bias creeping in or any forward-looking information creeping into that process. So yeah, it's just a simple top-down process. So, in simple terms, let's say you had six assets. So you had 4 equities, 2 bonds, say your equities were, I don't know, NASDAQ, Dow Jones, S&P, and Nikkei, and say your bonds were, I don't know, the US 10-year and the German 10-year, which is also called the Bund. The first thing you would do is say, well, I want my portfolio to be 50-50 asset classes, so half equities, half bonds. Okay. Then you've got 2 bonds, so those get 25% each. Then you look at your equities, you've got 50% of your money in equities. But you know what? 3 out of those 4 things are US. So maybe you'd want to go 50-50 that into US and Japan. So you put 25% in the Nikkei, and then you've got 25% split between the S&P, the Dow Jones, and the NASDAQ. And you know what? It's too hot for me to work out what 25 divided by 3 is, but whatever that number is. That's kind of the basic idea. And there are complexities in there involved around, for example, you wouldn't necessarily want to put half of your US portfolio in Japan, because unless those 3 US assets were identically correlated, because they're not, you would actually put a bit more in the US, reflecting the fact that some of the natural diversification there within the US. So that's a complexity. And then there are complexities around things like how you actually measure the correlation matrix and whether you do things like shrinkage. And it's complicated enough that I think
you could get in the weeds.
Yeah, exactly.
You could get in the weeds.
I mean, I've written books about it and probably written like 5 or 6 blog posts about it, and the code's hundreds of lines long. So it's something I can't describe very easily. But
yeah, that's something that your blog is really great. So that's something that we'll put in the show notes to drive people there. So
yeah, but in simple terms, it's top-down grouping, and that's the best, the easiest, the best way of thinking about it. And it's just about maximizing diversification with that process. Sorry.
Makes sense. So just a little bit of a backtrack, going back to stocks for a minute. So in futures, it makes sense to basically vol size, right? What about individual equities? Let's say let's say we have a 30 stock portfolio in the US, and that's part of a constituent, and that's one element that's going in to your portfolio. Would you vol size those 30 stocks, given that when the overall volatility of the market gets higher, the correlations tend to approach 1, or would you not go through that brain damage?
I mean, I probably would, because I just love vol targeting. The question is whether it's worth it, right? So as I said earlier, stocks are quite a nice asset class, because if you look at the S&P 500, the difference between the highest and the lowest standard deviation is probably like 2, or maybe it's a bit higher than that. But the risk of a stock is not that different from the risk of another stock, unless one of those stocks is just some crazy small cap liquid meme stock and the other one's like General Electric or something. So you don't get as much benefit from vol weighting as in stocks as in futures, purely because the range of vols is tighter. Whereas, like Ethereum's got an annualized standard deviation of like 100% a year. And I don't know, Eurodollar or US 2 years has got a standard deviation of like 0.5% a year. And in fact, if you go back a year, it was even lower than that. So you're talking about a range of over 100 times in terms of standard deviation. Yeah, you don't. This is why, actually, if you look at the academic literature, there's a lot of papers that have been written saying, well, you can't beat equal weighting. You don't need any of this fancy CAPM or vol adjusted or any of this stuff. Equal weighting is the best. And that's true, but that's only because the universe they're using to test that assertion is something like the S&P, where, actually, correlation structure is fairly nice, fairly homogeneous. It's not like the Canadian equity index, the Australian equity index. It's not massively biased. The standard deviations are different, but not that different.
If you put the Russell 3000, you'll get daily vols of 5, and then so maybe the average is 1, or it's going to be more than 1.
Yeah.
But maybe.
So as you move down to mid and small caps, then obviously in that case, vol targeting would make a lot more sense, definitely.
We vol target, so that's okay.
Yeah.
but it does make a difference. It definitely does. There's times when one of the things with equities that's interesting is that there's more of a relationship with volatility and the returns itself. As markets are rising, vols typically going down and vice versa. Yeah. Which kind of works in your favor. So I think there's another dynamic there and futures don't necessarily, I don't know if you've ever done any research on that at all with futures, whether or not the actual movements up or down relative volatility. Like when commodities are going down, is volatility generally higher than when they're going up? I think that may be true. I've never actually looked at that.
I think I've done something similar, not exactly the same thing. And equity indices, you see what you see in individual equities, definitely. Volatility, so the VIX, you see the opposite, which kind of makes sense because it is pretty much minus equity risk, right? But the other asset classes, there's not really anything there that's statistically significant. So no, you don't. I mean, part of the problem is that we've got bias samples. So if you take bonds, for example, bonds have mostly gone up in my data set, which is since, about the same age as me, so like 48 years, 50 years. So it's hard to say what bonds do when bonds go down, because they've not gone down that often in the last 40, 50 years. So it's very hard to do that. For something like commodities, where they've kind of gone up and down roughly equally, the data's obviously clearer, but the effects, it's not really there. You don't really see a strong volatility effect. So this is actually related to a theoretical result with equities, which is there's basically a leverage effect, because you can think of as an equity as a bit like a call option on the asset value of the firm. So that's why there's a stronger relationship between volatility and price for equities than for other asset classes. So it's not just like a curious empirical finding. There's actually a good reason why that happens in equities and only in equities.
Yeah. So the diversification factor, if you will, or in your model that you use, that is the one that's the most perplexing to me because it just seems to be like, in my mind, I always split it up into two things. What is the statistical evidence, and then what is the logical evidence economically? And then I just try to make a judgment call. But anyway, you've got some great books, and I encourage everybody to read these books. I like systematic trading. I just finished reading Leverage Trading. Really good book. If you don't understand how leverage works, some good stuff in there about what's linear, what's not linear, how Sharpe can be useful and not always a bad thing, things like that. So highly recommend it. I want to share your information out. When do you think that book's coming out, Advanced Futures Trading? Do you have any idea?
Well, I'm having a conversation with my editor actually over email now about this, in fact, exact subject. So I think if you go on like Amazon, it says it's going to come out on like the 13th of April or something like that next year. Oh, so okay. April next year. So yeah. It takes a long time to do these things. So
but you have a new cover, though. The cover looks great.
Yeah. Well, the guy, I don't do the covers. So the guy that does the cover is obviously much quicker at doing the cover than I am at writing like a 500-page book full of very detailed research and equations and stuff. I'm not trying to like brag or something, but there's a fair amount of work goes into these things.
Yeah, I know, definitely. And of course, so there's a little paper shortage going on right now. So some of these books are having a hard time getting out.
I'm hoping by April there'll be no paper shortage. So
keep your fingers crossed.
Yeah.
So Rob, thank you so much for coming on. I appreciate your time and taking it out of your day. Definitely learned a lot of great tips from you. So thank you for that. Is there somewhere you'd like us to send people to look at your stuff, your blog? I'll definitely put that on the show notes, but other than your amazing books.
My main homepage is systematicmoney.org. And yeah, there's links there to my blog and my Twitter account. If you're into coding, there's also links to my trading system, which is actually open sourced, GitHub. So yeah, that's kind of a good starting point from which you can look at all the random stuff.
I find it very interesting that you share so much of this hard work that you're doing. I think that's really great, helping a lot of people. A lot of people don't do that. A lot of the guys I know who just put this much work in don't share it. And I appreciate the fact that you do share.
Well, I'm extremely lucky to be in the position I'm in, which is that, well, part of it's also what I do. Like, I'm not trading like high frequency trading strategies that if I tell everyone about them, they'll stop working. So Right. So that it helps that I'm in the domain that I'm in, but I'm also very lucky to be in a position where I can share this stuff, and I don't need to kind of like bleed every last cent of monetizable value out of it. So
I should also mention that you have quite a few interviews on Top Traders Unplugged, and if anybody wants to hear more about Rob's, what he's been up to or will be up to, you might tune into that as well.
Thank you very much for that.
Thank you, Rob.
Thank you very much. Well, a great conversation. Thank you. Cheers.
For the latest episode of the Market Call Show, make sure to like, subscribe, and follow us on Facebook, Twitter, and YouTube. Go to marketcallshow.com for all our past episodes and sign up to get alerts for new episodes. If you enjoyed the content of this episode, please leave us a 5-star review and comments. The information in this podcast is informational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision. WealthNet Investments is a registered investment advisor. Advisory services are only offered to clients or prospective clients where WealthNet Investments and its representatives are properly licensed or exempt from licensure.